If your income is between £100,000 and £125,000, you are paying a higher tax rate than someone earning £200,000. I want to tell you about the moment I realized something was wrong. I'd had a good year. My income had crossed £100,000 for the first time, and I remember thinking, right, now things start to accelerate. Now the numbers actually work in my favor. So I sat down one evening and I did the maths properly. What came in, what I was actually keeping, what the effective rate looked like on that raise I'd worked 3 years for. And I found something that nobody, not my employer, not a single colleague, not anyone had ever mentioned to me. If your income sits between £100,000 and £125,000, you are paying a higher rate of tax than someone earning £200,000. Not because of a mistake, not because of a loophole someone forgot to close, because that is exactly how the system is designed. For every extra pound you earn in that band, you keep 40 pence. 60 pence goes in tax. The people who already know this, they've fixed it. They're not paying it. My name is Mark. Welcome to Wealth Architecture. In the last video, I promised we'd go deeper, that we'd look at how high earners legally avoid this. Today, we do exactly that. Let me explain the mechanics, simply. Because once you see it, you can't unsee it. Everyone in the UK gets a personal allowance. It's the amount you can earn before paying any income tax at all. For 2025 to 2026, that's £12,570. The moment your income crosses £100,000, that allowance starts to disappear. For every £2 you earn above £100,000, you lose £1 of your personal allowance. By £125,140, your personal allowance is gone, completely. And that withdrawal creates something that isn't printed on any payslip, isn't mentioned in any offer letter, and isn't explained in any basic guide to UK tax. It creates a 60% effective marginal tax rate. Here is the maths, step by step. You earn an extra pound above 100,000. First, you pay 40 pence in income tax, but earning that pound also removes 50 pence of your personal allowance. And that 50 pence is now taxable at 40%. That's another 20 pence gone. 40 pence plus 20 pence. Effective tax rate in this band, 60%. You earn £1. HMRC takes 60 pence. You keep 40 pence. Now, compare that to someone earning £200,000. Their marginal rate is 45%. They keep 55 pence in every extra pound. The person earning £110,000 keeps less per pound than the person earning £200,000. I'll say that again. Earning less, paying more. In this band, by design. I want to talk about why this keeps happening. Because it isn't stupidity. It isn't laziness. The people falling into this trap are some of the most capable people in the country. Senior managers, consultants, NHS doctors, engineers, people making consequential decisions every day. Think about how a promotion actually works. Your manager calls you in. There's a letter. Your salary goes to 110,000. People congratulate you. Nobody in that room says, by the way, the next £25,000 you earn will be taxed at 60%. Why would they? HR isn't there to do your tax planning. Your employer's job is to pay you. What you keep is your problem. We all carry the same assumption. Earn more, keep more. For most of the income scale, that's true. Between £100,000 and £125,000, the system breaks that assumption. entirely. And nothing on your payslip tells you. Most people have never calculated their effective marginal rate because nobody told them they needed to. That's not a personal failure. That's a design feature. The people who figured it out are playing a completely different game. That's what I want for you. Let me give you a concrete example. And I want you to feel this, not just understand it. Meet Alex, senior manager, just received a pay rise from £100,000 to £110,000. On paper, a £10,000 raise. Here's what actually happened. He earned an extra £10,000. £4,000 gone in income tax. £5,000 of personal allowance lost. Another £2,000 gone. Total tax £6,000. Take home £4,000. Effective rate 60%. Now take Sarah. She earns $200,000. Same employer, same 10,000 raise. She keeps 5,500. Alex earns less. Alex keeps less. Sarah earns more. Sarah keeps more. Same employer, same raise. Completely different outcome. This is not politics. These are just the numbers. So, what do? There is a legal way to bring your income back below 100,000 and restore your allowance. The most powerful tool is pension contributions. It reduces your adjusted net income, the number HMRC actually uses. 10,000 contribution, 6,000 saved, net cost 4,000. Effective relief 60%. Your provider claims 20%, the rest you must claim. You can go back 4 years. If you haven't been claiming this, check today. The second tool is salary sacrifice. Reduce salary. Employer contributes instead. Lower income, lower tax, lower NI. The income never lands. Your adjusted net income falls automatically. The third tool is timing. Same bonus, different year, different tax outcome. Act before April, because April comes around very fast. The system doesn't reward effort on its own. It rewards structure. Without structure, 60% disappears. With structure, the outcome changes completely. Alex's story doesn't have to end the way it started. That is not a trick. That is the system working exactly as intended for the people who understand it. 3 things. Calculate your adjusted net income. Find your number. Act before April. Restoring your personal allowance alone can save you over £5,000 a year. Structured properly over time, this becomes a 6-figure difference. If you know someone who's just crossed 100,000, send this to them before April. It matters more than they realize. And in the next video, the question becomes much bigger. How do you structure your entire financial life to minimize tax? Not just this year, but over a whole career. Thank you for watching. I'll see you in the next one.